Hello, everybody. This is Hashim Chaudhry, and today we will be talking about corporations. I find many times that people who own corporations or are looking or inquiring about a corporation don't really know what a corporation really is. So, today's video is going to help you better understand what a corporation is, kind of like a one on one, not without going into too much detail. It will help you if you're a business owner looking to incorporate, if you're an individual looking to start a business and wondering if it is the right move to do to move straight into a corporation. So let's get started. So let's define a corporation. To start with, I hear a lot of time people saying, well, a corporation is something where people have board of director, people have multiple owners, the shares can be publicly traded, things like that. All of that is true. However, a lot of time people don't really understand what a corporation truly is. A corporation is a separate legal entity. There's three parts to it, only three words. It's a separate legal entity. And what it really means that it is not you. Okay? A lot of times I find people, especially business owners, refer to their corporation as I, myself, my business. Well, if you're talking to anybody who is an accountant or to the revenue agencies, you will really confuse them up. So it is really important that you understand what a corporation is. It's literally a separate legal entity. So why incorporate? So people don't sometimes get people have a business idea and they just want to go incorporate. Well, it's not that, it's a simple process, but it's like creating a new person. It's a separate legal entity. You're giving birth to a new entity. So it's not easy to start. Of course, it's not cheap to start in many cases. It's not cheap to maintain, and it's definitely not cheap to file, because corporate tax returns can easily be 3, 4, or 5 times more expensive than a sole prop. So why do people incorporate? Well, there are 3 main reasons: business sense, legal, taxes. So what does business sense really mean? So sometimes you're going into a business where if you're not incorporated, you might not be successful in it. You might be entering an industry where people only deal with you if you're incorporated, or you cannot even operate because there might be a legal requirement that you must be incorporated in order to run that business. So if it makes business sense. Now, sometimes I would also add one thing to it. When you are incorporated on a business card level, of course, it looks more professional. I know, sometimes, and I'm sure many of us have seen this, that people would write director of this, CEO of this, but they're really a one-man show. So, I mean, back in the day, you might would get away with it, but people on the market is now very well informed that if you're writing CEO, they can very quickly pick up that you're really just a sole prop. You're really not incorporated. But, it looks more professional for sure. Business sense may also include things like you've come up with a product which you want to get a copyright on or a patent on, or you've come up with a name that you really want to secure. So it may make sense to incorporate at that time. The next category is legal side of it. Of course, a lot of times people will incorporate purely based on the legal protection. A corporation does add a legal layer, like a layer of protection, let's put it this way. to your business. So God forbid if something happens, you won't lose your house or your personal belongings. It is really limited to the business itself. Now, I do want to give one example over here, and that is of due diligence. Sometimes people think that, okay, I'm going to get an incorporated business and I'm going to do whatever I want to do because if I get sued, it's only the corporation. No, well, the court of law can't swing that the other way. Nortel is, one of the examples where we saw that the board of the directors actually became personally liable for the decisions they made. So if you're doing something illegal or fraudulent and you had a bad intent or you did not do your due diligence, a corporation's really not going to save you over there. And the next thing is taxes. Everybody knows corporations generally have a better tax rate than individuals. So how do you determine that if you're ready? So what we do over here is that we have come up with a general benchmark, which is around $45,000. So in other words, if your net taxable income on your personal side has hit 45,000, in other words, let's say you have a T4 of 20,000, you had a business income of 50,000 after expenses, it is 25,000. So 20,000 from the T4 and 25,000 from the business income. Well, now you're hitting that benchmark. So what is this benchmark really? So as I stated earlier, a corporation is expensive to start and expensive to maintain. So at this point, the cost of running the corporation equals the tax benefit. So, what are the costs? Incorporation costs, corporate filing costs, things like that. So if you're making, let's say, $60,000 on your T1 side or on your sole prop, it is beneficial in most cases for you to get incorporated because you will have a better tax rate over there. Now, if any one of these three things become eligible, you incorporate. It doesn't have to be all items that become eligible in there. So now we know when we need to incorporate. So very briefly, I want to go over what's the difference between self-employed and a corporation. Well, self-employed is really the individual themselves. It is filed on your T1 return along with your personal taxes. It is cheap to get set up and to maintain. Won't really say cheap to file sole prop taxes. I do want to take that back. But in terms of when you compare it to the corporation, corporate taxes are far more expensive than sole prop taxes. Losses can be applied so if you're in sole prop, losses can be applied to other sources of income to generate refunds. Okay, so that's very important. And a lot of time people do not understand this concept. In a business, cash flow is everything. So why not, I get asked this question all the time. Why not just go straight into corporation? My losses will be carried forward from year to year. Well, you know what? It may not be true in many cases because what happens is we pay taxes on the T1 side. We pay taxes on the net income. So if one of your net income goes into negative, so let's say you're starting up your business, it's heavy on expenses, and your self-employed side goes into a negative and you have a job. So let's say you have a job of $100,000. I'm just going to make these random numbers up. Please don't hold me accountable for these numbers, but just as a general idea. So let's say if you're making $100,000, you're easily paying about $35,000 in taxes. You start a business, and at the end of the day, you're with a loss of about $20,000. What it does to you is that it takes your taxable income down from $100,000 to $80,000. You have paid taxes on the $100,000 through the year, and when you really should have paid taxes on the 80. So you get a nice big refund. That refund can really go towards your business, back into your business. Well, in corporation, that doesn't happen. So a lot of times I will recommend people who are starting their small business, mainly services businesses for the most part, to start off as a sole prop because you have a job. Get those tax benefits for now, because that will really help you in your business. And once you start making profits, you can look into incorporation. The next thing I really want to look into, talk about is unlimited liability. In a sole prop, you will, if you get sued, they'll take everything. Whereas corporation, you may be protected for most of it. And in most cases, yes. Income on the sole prop side is taxed on the personal tax rate, and we all know that the corporate tax rates are much lower than the personal side. Continuity concern, briefly want to touch that. As a sole prop, if you pass away, the business dies with it. Whereas in corporation, you can pass it on, you can sell it. It's much easier as a transaction wise as well. So again, corporation, limited liability, lower tax rate, expensive to set up and maintain. Reporting differences. Bank reconciliations is the biggest one. One of the big ones, actually. There are other differences as well. First of all, you're jumping in from a T1 to a T2, so it's a completely different tax filing. Bank reconciliations are required for corporations, and it does take a lot of time compared to sole prop, where you are not really required to do bank reconciliations. And we'll talk a little bit more about why is that necessary further down in the video. Very often, if you're talking to your accountant and you're reconciling stuff, that really means you're literally doubling the work for your accountant or the bookkeeper in there. Both balance sheet and income statement have to be reported in a corporate filing versus only income statement in a sole proprietorship. So what does that mean? Whoops, let's go back. Well, 1 second. So in a sole prop, you only report your income statement, which is your T2125. Now in a corporation, you have to report your balance sheet as well. CRA is concerned about how much cash do you have in the bank. They want to look at all the assets, liability, equity in the in the company, and we'll talk more about it as we get to the next slides. HST rules for vehicle are a little bit more lenient when it comes to sole prop in terms of the chances of it getting audited. But when it comes to percentages, let's say you need to have 90% plus on a sole prop to be eligible to claim the HST on the purchase, where on the corporation side, you only need 50%. Another difference is, and as I said, it's more expensive to maintain a corporation. For a sole prop, if you don't run your sole prop 1 year, you just don't file your Schedule 2125, which is your statement of business on your personal taxes. Whereas if you're incorporated, you still need to file those zero returns or shelf the company, which is also another process. So I do want to mention one thing in there. I mentioned several times in the video that corporations do have a better tax rate. Yes, they do have a better tax rate, but when you start pulling money out of the corporation, if not managed properly, you might be in the same boat as you were before, because income pulled out of the corporation gets taxed on your personal tax rate. It becomes a personal benefit. And we'll talk about how that gets calculated also later in the video when we get to how to get paid from a corporation. So, big difference. You're a sole prop. You do not need to report a balance sheet. You only reported your income statement. Now you're incorporated. You need to report your balance sheet as well. Well, the balance sheet works on a very simple formula. Assets is equal to liabilities plus equity. So what are assets? So assets are pretty much what you own. Examples: your inventory, your patents, your goodwill, your cash, your account receivable, any prepaid expenses, furniture, fixtures, land, building, things that you own. That's the first side of the equation. The other side is liabilities and equity. Liabilities means what you owe. This could be things like accounts payable, so trades payable, in other words, things that you owe to your suppliers. Could be taxes payable, could be the money owed to the shareholder, could be a mortgage, could be notes payable, could be HST payable, payroll liabilities, things like that. That's what goes into the liability side. The equity side is pretty much the area where we manage the dividends, the retained earning, things like that, your shares. A bit of an advanced topic on a day-to-day basis, really doesn't impact the business itself unless you're publicly traded or you really don't know how to pull money out of the company. But for the most part, your equity area will be managed by your accountant, and you don't really need to worry too much about it. Understanding an income statement. So income statement you're familiar with. It's a pretty simple concept. Money in, money out. On a corporation, you will see revenues. That is the schedule 125. Revenues minus cost of goods sold. You get your gross profit. You deduct your expenses out of it. You get your net income. And whatever that is, you pay taxes on it. So, due to shareholder account. Now, this is one thing that almost all the time I find people who own corporations have no clue about this. And that's very unfortunate because this account predominantly determines how much income is going to go to your personal name. And we'll discuss how this whole account works. But to get into that, let's first define what this account is. It works on the assumption that the money loaned to the corporation by the shareholder is after-tax money, and when withdrawn in future, it is also tax-free. Some people like to call it working capital, especially in the academic books. It's referred to as working capital or shareholder loan or advances. This account manages how much benefit the corporation has received from the shareholder and vice versa. So if the corporation has received more benefit from you, and that could be in many shapes and forms, it owes you money. And if you have, on the other hand, if you have benefited more from the corporation than what the corporation has benefited from you through the year, you owe the corporation money. Or it is your personal benefit and you will pay taxes on it. Now, for CRA, the Canada Revenue Agency, they don't like a negative balance on this account. A negative balance on this account directly indicates the tax authorities that the shareholder has benefited from the corporation and it needs to be taxed personally. They don't allow it to be allow a negative balance to be carried forward for 2 years in a row. They will, in many cases, come back and issue you dividends. Now, this may vary in some cases. Sometimes CRA doesn't wake up for much longer periods of time, but one should really be careful on it. And your accountant, depending on where you are, will help you determine on how to manage this. As I mentioned, this is a current no, I did not mention. It's a current liability account on the balance sheet. And that's why we're going to discuss this more, because a lot of people don't get this. So, returning to basics again, let's do a quick recap. A corporation is a separate legal entity and you as a shareholder are a separate entity on its own. I've put the corporation in a box and the shareholder in an oval. Corporation is green, shareholder is blue. And I have put the due to shareholder account, DTS, at the bottom. So as I said, this account, the due to shareholder account, is very important, and it plays a vital role in determining how much taxes you pay on your personal side. Let's see how does this account work. So let's say, for example, you just incorporated the business, you went to the bank, open a corporate bank account, and the shareholder transfers money into the corporation. The corporation is personally benefiting, or is benefiting from the shareholder, and owes the shareholder this money. So this has a positive impact on the due to shareholder account. Now, I want to pause for a second over here. Many accountants will use due to shareholders and a due from shareholder account. For sake of understanding over here, I'm keeping it all together as one, because the due from shareholder is an asset, due to shareholder is a liability on the books. But the net effect is what really matters when it comes to how much income is going to be given to the shareholder for personal taxes. So coming back to over here, in this example, the corporation has benefited from the shareholder, therefore it's a credit to the liability account. When you credit a liability account, it goes up, so that's why hence I'm referring it as it having a positive impact on the account. Well, let's say you're at my office and I'm doing your corporate taxes, and we sign off everything, and you're about to leave, and I say, hey buddy, you can't leave the building unless you pay your corporate tax bill. Okay, so the shareholder says, well, I don't have my corporate credit card or the debit card or the checkbook, and in this case I'll have to pay it from my own money. So the shareholder takes out his own debit card, pays the corporation bill. The corporation benefited from the shareholder. It has a positive impact on it. The corporation owes the money to the shareholder. The corporation doesn't own an office, and the shareholder is providing an home office out of his own personally owned home to the corporation. The corporation is benefiting from it. It has a positive impact on the account. The car is personally owned by the corporation, owned by the shareholder, yet the shareholder is using the car for the corporation. The corporation doesn't own the vehicle, therefore it owes the money to the shareholder. In this case, it has a positive impact. We'll touch base on home and car right after this slide, because I know a lot of time people have questions in terms of, well, how do I record my home office and vehicle when the car is not owned by the corporation, or the home is not owned by the corporation? So we'll get to that shortly right after this slide. So the other way around, there's a bunch of money sitting in the corporation. The shareholder needs money, so it withdraws income out of the company, or just does a simple withdrawal. The shareholder is personally benefiting from the corporation, therefore it has a negative impact on this account. The shareholder is at the city, gone there to pay the property taxes, and realizes that they haven't brought their money, like the personal debit card. They have the corporate checkbook, they cut a check, they pay the government. Well, the home or that bill in particular is not owned by the corporation. The shareholder is personally benefiting from it. It has a negative impact. So same with the car. The car is not owned by the corporation, yet the shareholder or the owner of the company is paying gas bills and all sorts of bills for the car from the corporation. Well, it has a negative impact on the account, and the shareholder owes the money to the corporation. So what's happening through the year, there's plus minus happening in this account, the due to shareholder. So what happens in the end? Now, I did mention to you I will touch base on the car and the home. Let's return to this slide. If a corporation doesn't own something, you should technically, or in an ideal world, not run it through the corporation. Why? Because you're only creating more bookkeeping work. If you remember, I said that we need to do bank reconciliations in the books for a corporation. So if you're choosing to enter stuff in a corporation that is not owned by the corporation, well, the bookkeeper has to record that entry to do the bank reconciliations. You're only creating more work for no reason. In case if the shareholder owns the home or the office or the vehicle, money should be transferred to the shareholder from the corporation, and let the shareholder do whatever he wants to do or she wants to do with that money. Ideally, try to avoid it. Now, I know it's sometimes impossible. Sometimes you will see people or yourself paying personal bills from a corporation. It's okay. Shouldn't really happen, but it just creates more work for the bookkeeper, and in many cases that also means that your bookkeeping costs also go up. So in the previous slide we saw, I told you that don't run your personal car and your personal home from the corporation. So what does that mean then? Well, how do you record your car and the home? So for the car, your accountant will ask you how many kilometers did you drive in the year on your personal car that related to your business. They will multiply it by the rate prescribed by the Canada Revenue Agency. 48 cents for anything that's over 5,000 kilometers, and for the first 5,000, I believe it's 52 cents. So pretty much number of kilometers multiplied with the rate for the year. Again, check the rates for the year that you're doing taxes. They sometimes do change year over year. It's a journal entry made in the books at the year end, where pretty much debit vehicle expenses, credit due to shareholder. So the credit of the vehicle is given to the shareholder. Now, the HST cannot be considered in there if, there is a way to do it, but in many ways it's not practical. Shareholder owning the vehicle, you generally don't get to claim the HST on the vehicle expenses. So it is sometimes recommended, and in most cases actually recommended, that the car gets moved into the corporation's name to benefit for the HST as well. Home expenses, again, it's a prorated category. It's a year-end entry. Total up all the expenses, multiply it by the rate or the portion of the house that is used for the business, and debit home office expense, credit due to shareholder. So let's get back to the due to shareholder account. So as I said, through the years, there's pluses, there's minuses happening. And this account gets affected through the year. So what does it really mean? So let's say, here's an example. So through the year, the shareholder provided benefit to the corporation, and the corporation received benefit from the shareholder in terms of money, paying, getting their bills paid, car, home, and things like that. The shareholder gave benefit to the corporation of $10,000. However, by the end of the year, in terms of withdrawals and paying personal bills and things like that, he or she took out $50,000 out of the company in terms of benefit. This leaves the year-end account balance at a negative balance of $40,000. This shows CRA from the balance sheet that the shareholder has benefited $40,000 in excess of what the corporation benefited from the shareholder through the reporting period. This is an individual's personal income and they will pay taxes on it. Generally, this is if a payroll is not set up, this will come out as a T5 dividend. So that leads into how do you get paid from the corporation then? Well, there are three ways. You can do a payroll, T4 if you're in Canada. Taxes would be withheld from your employer, which is your corporation, through the year, and you are exempt from contributing into EI. Now, you can also get your spouse exempt from it. That's a completely different discussion. Don't want to go into there. But if you have questions, just ask me, and I'll get back to you on that. The other way is dividend, which is a T5. It's the lowest taxed income because it's treated as investment income. Many times, and in most cases, it doesn't trigger a CPP contribution. So it is not a long-term solution for a person who may be expecting CPP when they retire. So you might want to do a payroll and a combination of dividend. And the last one is management fees. So it's kind of like having a sole prop for the shareholder. Management fees are charged by the individual. Be careful that don't charge $30,000 or more, because then then the shareholder has to get HST registered as well, which is really a zero transaction in most part, because the corporation will get it back in their ITC claims. The shareholder has to remit it to CRA. So it's kind of like a balancing thing, but we need to be careful about that. Now, before I move forward, I do want to say one thing. It can be just one thing. It can be a combination of two, and can be a combination of three. It is a decision that you should discuss with your accountant, because he can run the numbers. I always look at all three options at the year end and see what works out the best for my client. So my last topic over here, a lot of time people, when they come to me and ask me, Hashim, I'm ready to get incorporated. And I ask them, do you want to get federally incorporated or provincially incorporated? So what are the differences? Well, the main difference in there is that between federal and provincial incorporation, the federal corporation gives you a better name protection. And for the most part, so let's say ABC Services gets registered in Ontario, so it's ABC Ontario Inc. Somebody in BC says, for the same type of business, I'm going to go ABC BC Inc. Well, if you're provincially registered, you cannot stop that from happening. Whereas if you're federally registered, you have the right. Your company or the name is protected federally within Canada, and nobody in Canada can take that name. Now, the other thing in there is that it has a wider rights to carry on business. In there, I mean, it's a completely different topic, and it's a completely different area, and I don't want to cover that in this session. But when you register federally, you still have to register in the province that you're going to be operating business. So what you really want to take out of this is that when you're federally registered and you're trying to do business internationally, international businesses are more comfortable in doing business with you. Why? Because they can search you up on Corporations Canada, where they cannot find a provincial corporation online. They can confirm that you're the person. It gives them more confidence. Plus, how you want to move in between different provinces within Canada as well. It is much easier to do in there. Again, if you want to really get into details, do contact me, and I will look at your individual case and your long-term goals with the business, and will make sure that you're set up right. Federal incorporation is cheaper than provincial, almost half price. The only downside to a federal registration is that you're required to file an additional return annually, Form 22. It's cheap to do, but it is kind of like an additional step that you have to take. But it's no big deal over there. So that brings me to the end of the presentation or the session on better understanding corporations for people who are looking to incorporate and want to know what a corporation really is. If you have any questions, feel free to contact me, and I will be more than happy to help you and look at your individual case and guide you through the process.